Thanks, Derek. I appreciate the opportunity to be here today. As Derek mentioned, I'm Drew Reynolds, Vice President of Real Estate with Realized Holdings. Before we get started, I do have to hit a few securities disclaimers. DST interests are offered as securities even though the underlying asset is real estate. And as such, I have to go over a few securities disclosures. This is not a recommendation to buy DSTs or any other security. Realize does not provide tax or legal advice. DSTs are private placements and are considered illiquid investments that may lose value. This presentation is illustrative only. With that said, let's move into the meat of the presentation. So start off high level here. Who is Realized Holdings? Realized is a technology-enabled platform that provides wealth solutions for high net worth families with legacy investment properties. Investors use the Realized platform to tax efficiently transfer wealth from legacy properties into passive, stabilized commercial real estate portfolios customized to their specific needs. So in this presentation today, I'm going to start at a high level and then I'll bring it back down to how DSTs may fit into wealth management or family planning issues for the investors that are listening. We have a diverse group on the line today, so I'm going to cover the 1031 exchange process and DSTs at the 30,000 foot view, and then I'm going to cover some more practical implementation. So why do we do what we do, or how does the 1031 exchange fit into overall situation? A little background may be helpful here. If you take a look at the stats on the top line, they're fairly staggering. It's no secret that the U.S. population is getting older. The baby boomer generation, especially, you can see 56.1 million families that are age 55 and over. And what we see here is, in many instances, real estate may make up a high concentration of a investor or a family's net worth, and it's typically not acquired in a cohesive plan. You know, often what we see is maybe a former primary residence, former business property, the family cabin that was inherited, maybe a couple single-family rental homes that are near where the investor lives, which may or may not be where the bulk of the family or their children live, or still live or want to live. So where does that put investors? That puts them, with a high concentration of their net worth, again, not necessarily acquired in a cohesive manner, and now the population's getting older. You can see there's an estimated 6.4 trillion of net worth trapped in these legacy properties. And the real problem is, if investors were to sell that and pay the capital gains due from those sales, it would trigger about 3.5 trillion of capital gains without an exchange. So for any advisors, CPAs, attorneys on the webinar, you probably have several clients who are in this situation. It's very common. And the issue here is that really that equity becomes trapped. As you mentioned, it can be a sizable component of their net worth, and paying taxes could basically erode a sizable portion of said net worth. But the investors are getting older. They may not want to manage. We hear time and time again what they really want to do is to travel while they still can and see their family and their grandkids. Dealing with tenants, making repairs, fixing toilets, probably not what they want to be doing as they're in that retirement age. And even with a property manager, there's still typically some oversight and administrative work that goes along with that. Then another thing to consider is you've got risk, which is often overlooked because it's hard to quantify risk in smaller direct real estate investments. But if we break it down kind of in a context that may be a little bit easier to explain, is you've got volatility in cash flow, in the sense that a lot of investors, what they own are smaller localized properties. So take the case of a single family rental, for instance, which is either 100% leased or 100% vacant. An investor could become accustomed to receiving that cash flow, but yet if a tenant moves out, you're going backwards. You may have a negative cash flow situation. Capital expenditures, especially depending on the age of the properties. A saying we use around here quite frequently is, your water heater going out away from zero cash flow for the year. And maintenance, labor, out-of-pocket expenses is maybe not ideal as that client is aging. And then finally, again, the properties were, as you mentioned, oftentimes acquired in a non-cohesive manner, which leads to really a lack of diversification. Of course, everybody's different, but depending on the studies that you read, something like 70% of investment properties owned within 50 miles of where the investor lives, and tends to be very concentrated in one property type. A common example might be owning 4 rental houses within 5 miles of their house. And perhaps the biggest issue of all is, so the investors we've established now, they're aging, they've got a big tax issue, and not much risk management kind of being brought into this overall equation. They're often hitting this transitional point of their life, whether it's inching towards retirement, thinking about estate planning, but there's really not a lot of resources available to help them in this situation. As the investor moves from the growth to the income phase of their investment, they may be thinking about things a little bit differently than they used to. So that real estate agent, which really provides, I'd say, transactional services, buy a property, sell a property, and is not trained in portfolio management and may not be privy to the investor's overall financial situation and objectives. And then you've got wealth managers who may not understand direct investment real estate, since it doesn't fit into the wealth manager model. So that's really where Realize comes in, is for investors who are looking for holistic situations to transfer their, I'd say, kind of chunky tangible assets more into a passive portfolio while still deferring taxes and maintaining a consistent cash flow. So I'm going to skip around a little bit here, but just kind of by way of background as to who we are. Realized is a marketplace and for 1031 qualified investments and an advisor to the investors that are in this situation. Our background is really that of a DST sponsor, which is the operator of the underlying properties. So we've been at this quite a while. In fact, the second DST that was ever done in 2005, core members of our team sponsored that. And we've been on the forefront of DST innovation ever since, as you can see from the highlights. The first DST to have more than one property, the first to be financed with the agencies Fannie Mae, Freddie Mac, the first what I call cash out transaction, and now what I believe to be the first secondary market, and I'll come back to that later. DSTs are a bit of an odd animal in the sense that they're issued as securities and therefore distributed via securities reps, so think your local stockbroker, who may or may not be well-versed in real estate. Realized is really the other way around. We come at it from a heavy institutional real estate background. Of course, we have all the requisite securities license in order to be able to handle these, but really we're, rather than it just being a product to accommodate our clients, really we're real estate first and foremost, who have the securities platform in order to be able to offer this to investors who are in this situation. So as I mentioned, I'm going to hit the 1031 exchange at a real high level. I'm going to assume that most investors at least have a rudimentary understanding of the 1031 exchange. So I'll keep this short. 1031 exchanges have been around since 1921. It allows investors to defer, though important to remember, not eliminate depreciation, recapture, and capital gains tax, so long as they reinvest the proceeds in more investment property. And like anything tax related, there's a whole host of rules and requirements that go around that. Big picture, an analogy is something like being in a 401k, in the sense that it builds wealth on a tax-deferred basis. And by deferring taxes, the investor is able to keep all of their money at work. So another concept that might be an appropriate analogy is like compounding interest. To the extent you keep your wealth building, over time, it can have a powerful impact on building the overall nest egg or wealth portfolio. So the issue for 1031 investors, I just mentioned that obviously it's able to defer the taxes, so why doesn't everybody do it? Well, as I mentioned, there's a whole host of issues and requirements that go along with it. First, you got real estate is relatively expensive and by nature is a chunky transaction. One of the rules that really makes it difficult is what we call the Goldilocks situation. And what that really means is in order to fully defer your taxes, investors have to spend or reinvest all of their equity, and they must also buy equal or greater property value. So from a practical standpoint, unless they really want to leverage up and buy a lot more property, which may have been the case when they were younger, but now from a lifestyle perspective, that might not be all that appealing. Really, they've got to buy something that's a very similar price to what they just sold. So fitting that exact right size property. They also have to identify properties within a 45-day window and then actually close on the properties within 180 days. So time and size requirements. And then you also have one issue may be market knowledge, and that the average investor is not in the market per se day in and day out. So there can be a steep learning curve in a short period of time. And they may be over their skis as they continue to trade up in property size. And then, as you mentioned before, a lot of the investors simply might not want to continue to manage, so that market knowledge and really stepping away from perhaps a property type that they're comfortable with makes it all that more complicated. So in short, the big problem for investors is large transaction, short period of time, potentially involving a substantial percentage of their net worth and requiring a skill set that they may not possess or a resource commitment they're not willing to make. So what is a potential solution? That's where the DST or Delaware Statutory Trust comes in. Big picture, Delaware Statutory Trust or DST has nothing to do with Delaware other than where the trust itself is filed. A DST is a grantor trust, similar to a irrevocable family trust, where basically the DST investor is acquiring a beneficial interest in the trust that owns the underlying property. DSTs were formally approved in 2004 by the IRS to bless the structure as being 1031 exchange compliant. Since 2004, about $20 billion or so of equity has been invested. DSTs offer the same protections from liability and then some of an LLC, basically being siloed off from other investors, property liability, etc. And perhaps the big one, which really makes it user-friendly to the investors, is DST investments are pre-packaged, meaning the sponsors or operators behind these go out and acquire the properties on their own balance sheet. So the property is already owned, financing is already in place, due diligence is already complete. So it drastically reduces the amount of execution risk to a investor, in the sense that they don't have to go out and negotiate contracts, get their lender to approve it, deal with unforeseen issues. That's already taken care of. So from an ease of execution standpoint, certainly makes things easier on investors. So who is the typical DST investor? Again, there's certainly caveats to this, and not all investors are the same, but really where we see the DST investor, who it typically appeals to, is that baby boomer generation. At Realize, what we typically see is kind of age bracket of 55 to 85, averages probably in their mid-60s. The probably key commonality that we see is investors who are in a transitional point in their life. Perhaps they're moving towards retirement, or at least slowing down. Perhaps they're thinking more about estate planning, or reached a point in their life where they just, I just don't want to do this anymore. I don't want to manage. That's probably the more common factor rather than age specific. Along with that is typically the investment orientation is moving from the growth stage to the income stage of their life. So done trying to swing for the fences. What they want right now is stable, relatively predictable, kind of fixed income-like returns. And as I mentioned a few slides back, they feel that that equity is trapped. Oftentimes they'd like to sell, but they don't want to, continue to manage, and they can potentially lose a large portion of their net worth if they pay taxes. So what they're really looking for is a way out without losing a substantial portion of their net worth due to taxes. And then, as I mentioned, when you move from the growth to the income side, oftentimes they're looking for more downside protection than they are upside. Time and time again, we'll hear that they want fixed income like mailbox money and willing to forego a degree of upside if it means potentially less risk or ability to limit their downside to some degree. The advantages of a DST. First and foremost, they are 1031 exchange qualified both into and out of the investment. This is important, whereas other ownership structures do not qualify. So for instance, an LLC, partnership, corporation, etc., does not qualify for 1031 purposes unless the entire entity is doing exchange into or out of the property. Here, investors are on their own. So although they may be co-invested with several other investors, each individual investor really controls their own destiny, both coming into and out of it, in the sense that they're not tied to other investors for 1031 purposes. The income derived from these tends to be, of course, there's risk with anything, but the underlying properties tend to be stabilized properties with high occupancy, good physical condition, typically in established markets. I would use the term core or core plus type profile. The income derived from a DST receives the same income tax shelters as owning direct real estate, meaning mortgage interest, depreciation, and there's also potential for pass-through, what's now called the 199A pass-through, depending on the income tax bracket of the individual investor. The underlying asset quality tends to be of the same type of assets that are owned by REITs, pension funds, insurance companies. So just to give you an example of kind of size and scale, they tend to be tens of millions of dollars per property. You can see the one that we've got up there as an example, which is a real life example, is a portfolio of $277 million of underlying real estate value. The DSTs are perfectly passive, meaning the investor is not at all involved in the day-to-day operations. They really just get a check every month. As I mentioned, they are pre-packaged, which means all the diligence is complete and closings can occur in a matter of days. The DST structure also allows investments to be perfectly sized. And as we were talking about before on the kind of Goldilocks situation of being able to find, the exact dollar amount or the exact leverage points in order to balance the exchange. Since the DSTs are unitized interest and prepackaged, an investor can invest virtually any dollar amount, subject to certain minimum requirements. But if you have an odd dollar amount, you got $213,842, the DST can accept, exactly that amount. So in terms of balancing the exchange and fully deferring taxes, can be made pretty easy. And that also plays into the ability to create a degree of diversification. First, DSTs may own multiple properties within a single DST. So the example we have here is actually a portfolio of apartments or multifamily where it was 4 properties in one DST offering. And then the other thing, like I mentioned, is because the investments can be perfectly sized, it also makes it relatively easy for investors to invest in multiple DSTs. So the ability to create their own customized portfolio, getting exposure to geographies, property types, different business strategies within their own discretion is, again, very much achievable because of the way that they're structured. And then we'll cover this more in detail, but for future divisible wealth transfer, the units in a DST are somewhat like shares in a stock, in the sense that they can be divided and transferred without necessarily having to divide or transfer all of the part. So as estate planning becomes more and more important, the ability to perfectly allocate interest in an investment to different family members or heirs may be meaningful depending on the investor's underlying situation and goals. Of course, there's no perfect solution, and like any investment, there are risks with the DSTs. The big one is that it is an illiquid asset. All real estate is illiquid to some degree, but here, since the investor is also passive, they really do not control when the property is ultimately sold. As we'll touch on in a moment, Realize has created a secondary market, which may make it possible for an investor to sell their interest prior to the sale of the underlying property, but still investors going into a DST investment should be prepared to have their money tied up for 5 to 10 years. And if that's not a fit with what they're trying to do, a DST may not be the best option for them in the first place. The returns, as you mentioned, are more income orientated on stabilized properties. So if you're looking for huge returns or looking to double or triple your equity, the DST is not that. We use the baseball analogy. These are singles and doubles. These are not triples and home runs. There are some operating constraints, namely it is a closed investment vehicle, meaning once the property is funded, there's really not a great ability for the sponsor or the operator to do things like renegotiate loan terms. There's no ability for future capital calls. Ability to make major structural improvements are also difficult. So the underlying property types work best with buy and hold type assets. Now, not to get too concerned, there are workarounds. There are kind of some safety net provisions, including a master lease and a springing LLC that should unforeseen circumstances happen. There is, in fact, a way to deal with that. That's a little bit outside of the scope of the coverage of this presentation, but for those who have questions on some of the more technicalities and nuances of either 1031s or DSTs, please reach out to Derek and we can get you appropriate information. So from there, I'm going to shift gears a little bit now that we got a basic understanding of DSTs, is how they work in action, how they fit into an investor's overall objectives. Here I want to stress a concept of what we call a solution over a transaction. And within the spectrum of your 1031 options, there's a lot to consider. So the first thing that we do is build a team around the investor, or at least take a team approach. As we mentioned, this is often a transitional point in an investor's life, and they may or may not have all the tools and resources they need. We do have a referral network, CPAs, financial planners, attorneys. First thing we want to do is make sure that the investor understand what they're trying to accomplish, bigger picture, what is it they want from this transaction? Do they have the appropriate tools and resources around them? If not, let's get that squared away first. From there, what we look at is where do the DSTs fit within the range of options that are available to the exchange investors, and make sure that we're matching investor objectives. So if we move from kind of left to right on the spectrum, on the left side, what I say is more transactional based, which is, you sold a property, you could go back and obviously buy another property. Common example, you sell a rental house, go back, buy another rental house. Kind of moving away to lesser landlord duties. If getting out of the management game is important, you look at a triple net property. So here, for instance, perhaps you're buying a Burger King or a Walgreens or something that day in, day out may not have landlord duties, but there still may be some underlying administrative work from here. Then as we move over here, this is kind of a one-off DST or tenant in common voting or syndicated offering. Depending on the structure, tenant in common, for instance, may have voting rights or capital calls, which may or may not be what the investor is looking for. And then as we move more into the solution base, and the reason I use solution is that, the real estate's always been kind of viewed as a transaction. Sell a piece of real estate, buy a piece of real estate. We take a slightly different approach and say, you've built a lot of net worth through owning this piece of real estate, but now you're at a point where you don't necessarily need to buy direct real estate. So in an ideal world, what would your portfolio or your retirement account look like? And by using DSTs and thinking of them sort of like as building blocks, you can create that more diversification. And then within the actual real estate offerings themselves, there are some characteristics of the properties that look and feel similar to other financial products. So for instance, net lease over here has some resemblance to a bond in the sense that you typically have a corporation guaranteeing the lease for an extended period of time, so it becomes fixed income like, whereas apartments may be a little bit more like dividend paying stock in the sense that you could have some operational variance, which could make the dividend like component of it a little bit more variable, but perhaps there's more growth component behind it on the back end. If we continue to move to the right here, these are a couple of innovations within the kind of DST world. As we mentioned, we'd recently done what I call a cash out transaction. And then there is also a way to indirectly do a 1031 exchange into a REIT or real estate investment trust, which provides greater diversification and potentially greater liquidity. So this is just kind of an overview of where we see the scope of services in the overall continuum of 1031 options. And maybe one other important point to hit on here is these are not necessarily mutually exclusive. Depending on the size of an investor's exchanged, oftentimes they may be buying direct property and using some of these DSTs or other products. And we have the ability to kind of lump that all into our portfolio modeling, and that very well could be the best execution for the investor. Again, really just depends on what the investor wants to achieve out of this specific bucket of capital that's available to them. So how does this work? How do we do all these? We run a process, and frankly, it's not right for everybody. We run a little bit more of an open and iterative approach. Again, if you move away from that kind of transactional real estate and more into something that's a financial planning exercise, that's a little bit more about how the process works. We want to take into consideration the investor's tax situation, their risk and return profile, financial and lifestyle goals, anything else that may be important to helping construct their investor-specific portfolio. The process itself starts out the same as really any real estate transaction. You're going to sell it through a traditional real estate channel. The money from there is held by a qualified intermediary. And we have, a network of qualified intermediaries we can introduce you to if you do not have one. Once you go in there and you start talking about constructing the actual commercial real estate portfolio, one thing that the stance we take here is neutral representation. We're not going to pitch a single DST. First thing we want to do, as I mentioned, is run an estimate of a tax liability, and there's been many times we might just say, it's not that bad. Maybe you should just pay your taxes. And then in that neutral representation, there's really not such thing as a perfect deal or a perfect deal for all investors. The deal that works for one person may be something different than what the next person is looking for. And there's pros and cons and risk with every investment. And what we want to make sure here is that we're understanding the investor's overall investment objectives and have them understand where the risk and maybe more importantly, where the trade-offs would be. Again, there's not really a perfect deal. So which deals make up what would be closest to your ideal portfolio, and what, if anything, are you trading off in order to get the broader overall portfolio execution that you're looking for? So really our job is just to educate on the merits and the shortcomings and the risks that an investor can make informed decisions. And again, this may or may not end up being DSTs. We're product agnostic and solution, not transaction based, meaning if paying taxes is the best answer, then, so be it. If including direct property is part of the best solution for that particular investor, then that can be modeled into the equation. Here we just kind of want to take the longer term view and do what makes sense for the client and help them understand, how that fits into their overall goals and objectives. And then the process is a bit of a living document, meaning there's typically multiple iterations. We can run different scenarios so they can see what the portfolio would look like. And then there's going to be some back and forth until we work on what is a plan that meets exactly what that investor is looking for. Now, this is technology enabled, which allows us to run some of these models on a quicker turnaround and be able to measure things like pre-tax and after-tax returns specific to the investor. But ultimately, it's only enabled. It's not a it's not a robot. There's still somebody on the other side of the phone that can answer all your specific questions and help walk you through everything. Once that portfolio has actually been constructed, then there is the ability to monitor the portfolio. So it's a bit like checking your stocks and bonds on the Schwab account. It serves as a centralized hub with all the underlying offering documents, year-end statements, which becomes basically the more and more diversified an investor becomes, I'd say the more benefit this has in being a centralized hub to find all your resources and see how things are doing. And then this also provides or a place to have some alignment with Realize being an ongoing resource for you if you've got questions, et cetera, as the properties continue to operate. It's nice to know there's somebody that you can actually call and get some answers from. So now we'll take a little closer look at portfolio construction that I touched on in the previous slide. The way we think about DST interest is unitized building blocks of direct real estate ownership. If you look at this slide, each one of these blocks represents DST interest in a specific offering. We've made them all the same size for the sake of this example, but they could obviously be bigger or smaller depending on the weighting an investor that makes sense for a specific investor. DST interest is we touched on briefly, are in some respects tax optimized in the sense that they afford the investor all the same tax benefits as direct property ownership, mortgage interest deduction, even though the debt is non-recourse to the investors. It allows for depreciation allowances to the extent that the investor has remaining basis, and also it's 1031 exchange eligible going in and out. So really almost like a kind of a hybrid between a REIT share and a indirect property, which a lot of these benefits are not the case, or all of them from a tax perspective with other ownership vehicles. From a wealth management standpoint, the theory of building blocks allows investors to, over time, create a customized portfolio or mutual fund of sorts of real estate interest. And because the investments may be perfectly sized, it's possible to achieve portfolio allocation targets. For instance, you want to end up at 40% in apartments, 20% in retail or whatever. That can be very much achieved because you're able to split equity coming out of one deal and buy these various blocks of DST interest. And then as I touched on briefly, there is also, although they're real estate interests, certain property types and business plans that may be a little bit more stock-like or bond-like. Certainly not a perfect correlation, but again, if you're stepped away from real estate for a moment and thought about what you would like your overall portfolio or retirement plan to look like, a lot of the same traditional securities portfolio modeling concepts apply, and we're just using the building blocks to be able to tax efficiently take or transfer the wealth out of your direct property and into a more passive portfolio. So as a actual example, here's maybe a DST solution in practice that we did a couple months ago. This is an interesting one where the family had inherited a well-located piece of land. That land was later contributed to a REIT that built a student housing project. And so long story short, did very well for them. But now the REIT, which they had contributed the land to, was going to be selling the property and basically forcing the investor into a sale. First thing we did was build that team around them. it was a complicated situation where the property had gone all the way back to a corporation that had housed a former business owned by the investor's father. And really the way that the deal is structured up front is it would not have allowed for the investor to have even done a 1031 exchange based out of this joint venture relationship. So the first thing we did was found the appropriate legal team in order to work with the investor to convert that structure to make it exchange eligible. If you can see up here, if they hadn't done an exchange, they were looking at netting close to $11 million in equity and would have owed about $6.6 million in taxes. So obviously figuring out a way to have exchange eligibility was a critical component of the overall transaction, whether or not they ended up going into the DSTs. From there, as you mentioned, every investor's got a unique set of investment objectives. In this particular case, the investor who was leading the charge had two siblings that were also equal stakeholders in the transaction, but really didn't have maybe the financial wherewithal as the investor who was leading the charge. So that investor had to come up with a fair and equitable plan for all three of the siblings. In this particular case, that family lived a pretty modest lifestyle, although this asset represented substantially all of the net worth of the three siblings. So, critical transaction for all that involved. And, since they had this represented a fair amount of equity to them, the goal was really steady income and capital preservation. They were willing to forego upside in exchange for certainty of income and hopefully limiting their downside based on where they were. They also had a relatively high amount of debt to replace by DST standards, which is up at around 60% leverage, whereas most DSTs are typically in the 50 to 55% range. So we had a few constraints to work with. End result, they ended up investing, changing out of one property into 7 different DSTs. Some of those DSTs had multiple properties, so what they ended up with was exposure to 39 different properties in 18 states across 4 property types, with an aggregate property value of, if you took all the underlying property value of those DSTs, it added up to about $1.264 billion. So again, kind of moving from one $30 million asset into 39 properties now worth $1.25 billion. As I mentioned, they were really looking at this as a fixed income type return. We were able to get 88% of the cash flow being contractual and more in that net lease stage, backed by corporations. 81% of that investment was backed by investment grade tenants, including 40% that had AA credit, which is roughly the same as the U.S. government, and have an weighted average lease term of about 18.4 years. So really switched this from an equity position to in some regards, something resembling a diversified bond or fixed income type portfolio, which was in line with what they had envisioned, or really what they wanted from this transaction. This ended up being in a high degree of income tax shelter. In this case, nearly 100% of the income was sheltered in the first year. And then because they were going in similar type properties with the net lease structure, one way that we looked at diversification was staggering the anticipated rollovers, or really looking at this in kind of like a bond ladder or a bond maturity ladder, so that they were not 100% of their equity would be rolling out at the same time, and the chance that future economic conditions aren't exactly what they'd hoped for. They weren't putting all their eggs in one basket, so to speak. Kind of as a side note, we had originally also helped explore some direct triple net properties with them, and actually made a great deal of sense to potentially incur or include some degree of direct property. We helped them underwrite and evaluate all the specific ones that were going in there. At the end of the day, really the driving factor, and this is obviously case by case, but what really came down to was that since they had a leverage requirement, the local lenders were going to require the investors to sign personal recourse to obtain a loan on a individual property. So here the investor felt that they were able to really have exposure to similar type properties that they would have bought outright, obtain similar debt levels that they would have, but do so on a non-recourse basis and remain totally passive. So given their goals and objectives, it ended up being the case that at the end of the day, they went 100% into all DSTs. As we mentioned, this is also a transitional point in an investor's life. So I'm going to switch gears for a moment here and talk about some of the estate planning components of the DST. One, DSTs are eligible for a step-up in basis. This is certainly not unique to DSTs. Like any financial assets, the heirs or the beneficiaries to the estate receive a step-up basis equal to the then current market value. Where this is a little bit different with real estate taxes is that you've got the capital gains, but you also have the depreciation recapture, which means the longer an asset has been held, the greater the potential tax liability is when it's ultimately sold. What happens here is once that it's inherited, it's really as if the heir had acquired that property at the then market value, which basically wipes the slate clean as to the tax liabilities. Now, once it's inherited, it's the same situation as if they had purchased the investment, meaning that now a new depreciation schedule and future 1031 exchanges, et cetera, all those requirements are in place. So basically the tax hit goes away, but then that's going to bring up, liquidity options. So what happens now that the interest has been marked up to the fair market values, tax liability has gone away. The heirs of the estate might be thinking, how do I get out of this? So transferability and divisibility. So there's really no prohibitions against transferring a DST interest or portions of the interest. So although a 1031 exchange must follow the same taxpayer provision, once they're inside the DST, there's several options with proper planning. The interest may be transferred to investor-related entities. So oftentimes, maybe you held a property in a LLC, but once it's transferred into the DST, you could contribute that out of the LLC into a family trust, again with proper planning and the guidance of your attorney. You can also transfer the interest in a DST to any other party, so as long as they're accredited. And then the divisibility. So you're taking, your bulk of, let's say you put $100,000 into a DST, you don't necessarily just have one big share. That can be peeled off into, maybe 1,000 different interests or shares, and parts of that can be transferred. So in terms of charitable giving, gifting, estate planning, the divisibility and transferability, leads to a lot of options. Again, we'll certainly want to recommend you talk to your accountant and or lawyer before doing any of this. But one thing that we see here is that the ability for family peacekeeping and cleaner estate settlement when the heirs are receiving a specified number of shares. Compare that against inheriting single family home, for instance, and you could have kids fighting over, do they want to continue to operate it, sell it, when's the right time to sell, etc. Here it's really not much different than inheriting stock in the sense that each kid gets X amount of shares, if you will, and it just can help clean up the actual settlement. And it also provides optionality. The investor they possibly may be in a higher tax bracket at the time they sell. And with the divisibility, should they wish to recognize the gains, they can do so on their own time frame, potentially doing so in years of lower tax rates, or maybe they have losses, etc. So again, you're selling one big chunky property, turning it into shares that can then be broken off and sold, transferred, otherwise on the time frame that an investor desires. Liquidity options, and probably the number one objection to DSTs in general is not being able to control the exit timing. And while investors generally understand that real estate is illiquid and typically a medium to longer term hold, there's always the worry about the just in case or the what if I need it. And so I do need to stress that DSTs are classified as illiquid. and really investors should not be going into the transaction thinking of them as a trading or flipping type asset. But the good news is there are now some viable liquidity options. Realize this really had a heavy hand in two of the three that you see up here. And I'm just going to kind of touch on these briefly because they are a little bit more complicated situations that we can talk about kind of on a case-by-case basis. But the first is a cash out, which is really a structured refinance within the parameters of the DST. In this case, it happens immediately. Investor comes in on 100% equity, and then a loan to some degree is funded within a few days back. When that loan comes back, the equity that's received allows the investor to really use it any way they want. It's no longer tied to real estate since it's loan proceeds. So in some cases, this may be a more tax efficient way than, for instance, doing a partial 1031 exchange or not doing an exchange and paying tax. So for instance, you've got a daughter's wedding or college tuition or whatever coming off. This may be a way to fully defer taxes and access a portion of the cash up front. It's important to note that this is not free money. It's got to be repaid within the context of the DST. And there are some other requirements going along with it. Again, may be worth exploring depending on the situation. One common example we use is the kind of selling the family farm example, where let's say you've got 80% of your net worth tied up in a single asset, and if you pay taxes, maybe that's going to be a 40% tax hit. So maybe, and if there's no debt, perhaps it makes sense to go into one of these cash outs, fully defer the taxes, get some money back out, and then take that money and put it into more liquid assets, buy municipal bonds or mutual funds or something like that to at least diversify a bit outside of real estate. Second one is a 1031 exchange into a REIT. You cannot exchange directly into a real estate investment trust, but there is a way to do so by combining two parts of the tax code. Essentially, you use a 1031 exchange into a DST, and then the DST is later contributed via Section 721. I'll spare you the details of it, but long story short is it eventually converts shares, or converts the real estate interest into shares in a REIT, which they then may provide for liquidity. We typically see this of interest in investors who just value liquidity, or more commonly when it becomes very focused on estate planning, as we mentioned with that step up in basis. If you perhaps have older matriarchs or patriarchs to the family trust, that being able for the heirs to have relatively instantaneous liquidity upon the passing of the head of the trust may make sense for estate planning. There's a reason that not every investor would want to go this route. Once the DST is converted into a REIT, that is the end of the line as far as 1031 exchanges go, meaning once you sell those shares, you will owe taxes on them. So again, really, this is more of a kind of a future planning tool, more so than the investor who's looking to continue to invest in real estate. And then the final one I'll touch on here is a secondary market. Realize recently created what I believe to be the first and only active secondary market for DST interest. And we've recently completed one of the first transactions. So this is really, typically an investor's investment in the DST is tied up until such property is sold. However, there's going to be times when an investor wants to buy or sell an interest prior to the sale of the underlying property. Here we've created a securities compliant marketplace that allows investors to do that. And an interesting tidbit here is the interests themselves are considered real property, meaning even though the underlying property has not sold, buying or selling interest within the secondary market is also eligible for a 1031 exchange. So this allows investors the ability to acquire what I call seasoned interests, DST interests that already have an operating track record, and also allows them to get out early if desired and potentially just provide another portfolio management tool if you're looking to stagger or ladder maturities or just want to maintain options. So now, with all that kind of tools at your disposal in mind, I'll flip through to go back to that building blocks example and see what it looks like in action. So unlike direct real estate or other co-investment structures, DSTs are unilateral contracts, meaning the investors are able to stay passive, no capital calls, etc., which is really what makes it possible to break off these pieces. Like, for instance, you really couldn't break off a 5% piece of an LLC and sell or gift that to somebody else without jumping through a lot of hoops. This also makes them able to be passed in a tax efficient manner with minimal friction for doing so. So a few different examples for investors: they can direct the income stream, or they can give away the interest themselves. As we touched on with family dynamics, there's a way to gift equal share to the children rather than, Bobby gets the house, but Susie gets the cabin. Here, there's actual uniform interest in giving those or passing those to the chair or to the heirs. So in this example, we started with the building blocks from the few slides prior. Here, maybe they've given some shares to a couple of the children. Something pops up or there's a better opportunity, able to utilize the secondary market, in this case, sell maybe one whole interest, if you will, and then maybe break off a piece of another one. And then really a topic for another day is the how this fits into charitable giving, where giving large lumpy assets to a charity is maybe not in the best interest of either the charity nor the donor, whereas it may make more sense from a charity's budgeting perspective to receive interest over time, and it may also be more tax efficient for the donor to do so, as there's annual gifting limitations. So here, if you've got your big, bulky $2 million property, rather than giving it to the charity all at one go, perhaps it makes more sense for both to convert it into DST interest and then gift down those interests over time. Again, something we can cover in greater detail at a different day, but really just wanted to be able to illustrate how this concept of the building blocks and options for divisibility and transferability may play into an investor's longer term overall investment objectives, and not just looking at it like a standard real estate transaction. So with that, that's all I've got for today. If there's any questions, please reach out to Derek and we will get back to you as soon as we can. Thank you, everybody. Very much appreciate your time and the opportunity to be here today.